Hi, Todd Dunn here on March 4th, 2018. This is the first video in a series of videos that I'll be doing over the next few weeks on retirement income planning. Now, I'm not going to be giving you specific advice about how to plan your retirement income, but what I'm going to do is go over various options that you might have. And this first video is going to look at the basic considerations for retirement income planning and what some of the options are, although I'm not going to go into details about the various retirement income options. First, let's look at what the basic considerations are in setting up a retirement income plan. Obviously, the first thing you have to know is how long are you going to live? Well, that's a little iffy, and basically it's unknowable, but I'll be talking about that a little more in a second. Then there's whether or not you would like to manage your money yourself, or you would like to get professional assistance, or perhaps just turn your money over to a money manager of some sort. Then you have to decide if you want to structure your retirement so that you draw down your capital during your retirement, or you want to retain your capital. And finally, what are the different income generation options? What I'm going to do now is look at each of these topics individually. Let's start with the toughest question first. How long will you live? This is an important thing to know if you're going to plan your retirement income. Unfortunately, we really have no way of knowing how long you're going to live. But there are a few things that we can look at that will at least give us some guidance. First off, you need to consider your personal health and lifestyle. Are you healthy, or do you have some sort of health issues? Do you live a healthy lifestyle in a safe place, or perhaps you don't live such a healthy lifestyle and live in a very dangerous place? Then there's genetics. How long did your parents live? Are they still alive? Are your parents 90 years old and going strong, or did they die in their 50s? And no matter how carefully we consider our health, lifestyle, and genetics, it's going to be impossible to say how long we're going to live. However, we can get an idea of average longevity or life expectancy. In the United States, the Social Security Administration has done the heavy lifting for us, have done tons of statistics and analysis of lifespan data, and have published what are called actuarial life expectancy tables. And I've got a link to one right here at the bottom of the page. In the next slide, I'm just going to look at the most recent actuarial life table from the U.S. Social Security Administration and explain how it works. Okay, this is a simplified version of the 2014 Social Security Administration Actuarial Life Table. What these tables do is they list life expectancy by present age. So let's look at a few of these numbers. If you are 62 and male, you would have a life expectancy of 82 years. And if you were female, you could expect to live on average to 84.9 years. If you are 70, you've already lived 8 years since you were 62. If you're male, you might expect to live to 85.3 years. And if you're female, 86.5. Okay, these tables provide us with an estimate of how long we might live, but they are population estimates. They don't say anything about the individual. You're going to have to consider your personal health and lifestyle and genetics when you look at this table to get a general idea of where you might fall. You might expect less than the number you get from the table or more. but that's an individual determination. Furthermore, if you are going to use these numbers in your planning, I would strongly recommend that you don't use the exact numbers, that you tack on a few extra years, because the one thing you don't want to do is underestimate your lifespan and run out of money. Now let's look at self-management of your money versus professional management of your money. The first question you have to ask yourself is, how comfortable are you with dealing with money? And I'm not talking about balancing the checkbook and paying the monthly bills here. I'm talking about potentially large sums of money. Are you intimidated by $250,000? Are you going to be indecisive because the risk of committing your money one way versus another gets to you? If you find that you're not comfortable dealing with money and would prefer to have professional help, what level of help do you want? Do you want advice that you will then act upon yourself? Or do you want active management, where basically you turn your money over to someone and they manage your money and generate an income stream for you? These are very different considerations. And when you make the decision to deal with professional money management, you have to look at what type of person are you dealing with. There are basically 4 types of money managers. There are registered representatives. These are essentially stockbrokers who will, at your instigation, buy and sell stocks and bonds for you. There are financial planners. Well, unfortunately, pretty much anybody can be a financial planner. I could be one, although I'm not. Financial planners come in different flavors. They have different certifications. You probably, if you decide to deal with a financial planner, should deal with somebody who has certification from an agency within your state, or maybe is a certified public accountant. At least these people have met some basic requirements for the certification. Then there are financial advisors. Financial advisors are held to a higher standard, both in training, certification, and fiduciary responsibility. Fiduciary responsibility is important because it means that a financial advisor has a responsibility to act in your best interest, not in the advisor's best interest. And finally, there are money managers. Money managers are people that you turn your money over to, and they manage your money in the way that they feel is best for you. And if you do deal with the money manager, you want to find one who also has a fiduciary responsibility to you, so that they don't simply deal with your money in a way that generates maximum fees for them. That brings us to fees. There are basically 2 different fee structures for professional money management. There's fee for service, where, for example, if you go to see a financial planner and have a meeting and pay a fee for that meeting, or the stockbroker might charge you a fee to buy or sell stock. Then there's management fees. Management fees are frequently based on the total amount of money that's being managed. That fee may be a percentage of how much money is being managed. And that percentage, it does not depend on how well the money is managed. You could lose money in a year and still have to pay 1% of your capital as a management fee. That brings us to the question of whether or not to spend your capital down or to retain your capital and simply draw out earnings. What are the pros and cons of the 2 positions? Well, if you spend your capital down, and include capital drawdown as part of your earnings, you'll have a higher income generated from a given amount of money. On the negative side of that, there is the possibility that if you guess wrong about how long you're going to live, that you could run out of money. Also, as you get older, the capital that you have on hand will be decreasing. So in the event that you suddenly have a need for a chunk of cash, it may not be there. What about capital retention? If you retain your capital, it gives you the opportunity to leave an inheritance. It also provides you with a built-in emergency fund for things like high healthcare costs. Also, if you retain capital, there's much less chance of running out of money. And if you retain all of your capital and simply draw the income from the capital as your income, you'll never run out of money. But the plus side is you can do both. You can earmark a chunk of your capital for retention and another chunk for drawdown. And that way you get the best of both worlds. Although you will generate an income intermediate between the two extremes. That brings us to the final bit of this presentation, and that's income generating options. What are they? Well, there are lots of possibilities. However, those possibilities may be restricted to some extent by the source of the funds that you have for generating retirement income. If those funds, for example, are in something like an IRA, a 401k, or a 403b, then that can place some restrictions on how you can use the money. For example, in those three classes of tax-sheltered investment, you cannot retain capital. You are required by law, once you hit the age of 70, to take out minimum distributions that get bigger every year for about 15 years before they finally start decreasing. And they're set up so that by the time you're hit about 102, your money's gone. There also may be tax considerations. Any money you take out of a tax-sheltered investment, like an IRA or 401k, is fully taxable. In contrast, money that you take out of your savings account is not taxable, although the earnings on the savings account will be. So, let's look at what some of the basic options are. One option, annuities. Annuities provide you with a guaranteed income stream for some period of time, in many cases, the rest of your life. But you have to turn your money over to the company you buy the annuity from. And you're betting that you live longer than the life expectancy that the annuity is based on. So annuities are one option. They provide certainty, but they do have restrictions. Then there are stocks and bonds. You can invest in stocks and bonds, and you can either live off the income in terms of capital appreciation or dividends and interest on the bonds, or you can gradually draw down. Either way, you can either do capital retention or capital drawdown. Then there are savings accounts, certificates of deposit, and money market accounts. You can put your money in there. It's very liquid. Then there are other investments like real estate, which can provide both income in the form of rents and potentially capital appreciation when at some point you sell the real estate. And of course, you can do a mix of all of the above. There are lots of different income generating options. They are quite complex, both in terms of how you structure them and in their tax consequences. So I will be doing individual videos on annuities, stocks and bonds, savings, etc., to try to point out some of the details associated with these different types of retirement incomes. That wraps up what I wanted to say in this video. Thank you for watching. Give me a thumbs up if you enjoyed the video. And please subscribe to my channel so that you will get notification when my next video comes out. Thanks again for watching.